everybody, and welcome to our July monthly discussion meeting. I'm joined by JR Gondeck and Megan Kowalski, as always, and we're picking up where we left off last month on our discussion about AI, artificial intelligence, semiconductors, and what we want to focus on this month is really on the different investment opportunities. Obviously, as everybody has seen, the AI space has been exploding over the past few years, and the question I think a lot of us have is really what's happened so far. And I think what's more important actually is to kind of discover where you're at from your own investment standpoint. Whether it's in some of the individual names or if you don't have those individual names, if they are in different types of ETFs or mutual funds that you might have held in different retirement accounts or things like that. And JR, can you talk about that exposure a little bit?
Well, and I think, Michael, like as we talked about last month, it's like a generational change that's unfolded and much quicker. Overall, the adoption of AI and the companies benefiting much quicker than anticipated. If you were the beneficiary of having exposure to that, your portfolio has done extraordinarily well over the last 18 months to 2 year range, right? And then, kind of as a follow-up this month, a little bit like you're saying, Michael, where is your exposure? How much do you have? Or if you have cash to invest, where is the opportunity, short, intermediate, and long term, overall? Because as we've had conversations with many families over the last number of months, holdings, like I said, within 401ks or other investment vehicles, when you look under the hood, so to speak, of what those mutual funds or exchange traded funds own, you might be surprised how concentrated the exposure is on some of these underlying companies, right? On the one hand, they've done extraordinarily well. On the other hand, as we've seen in the last week or two within the markets, there's a rotation unfolding near term. And the challenge is that going to persist or is it a blip in a long-term trend? But again, I think it's really good to understand in looking where that exposure is than mutual funds and ETFs within your portfolios.
Right, Megan, I think you had some data that we were talking about on kind of what some of those percentages might look like.
Yeah, so something to note is you might not think you have direct exposure to the semiconductor space if you don't have some of these individual names. But if you own the S&P index, for instance, without saying any names, just with one of the semiconductor companies alone, that's about 7% exposure to that semiconductor company by owning the S&P index. If you own the QQQ, about 8%. Some of these sector specific indexes, you'll have even higher. We're seeing 20 to 21% with just one name. So to Jared's point, it's great if you had exposure because your account is probably up on the year around 15%. But what you might not realize is you have a built up concentration risk in some of these direct names that have exposure to the semiconductor space. So it's just time to kind of look under the hood, assess the situation, and see if you need to rebalance. For instance, we have individual positions. We own a lot of these names in this space, and we're just actively trimming along the way to make sure we don't have outsized risk if something were to happen. And so it's probably not a bad time to take some profits off the table, especially if you have this in retirement accounts where you're not having to deal with capital gains, just to reduce a little bit of the risk profile for some of these specific names since there is so much overlap in some of these funds now.
Well, and you look at part of the reason why, Megan, like, look at some of the political risk that's out there that could cause, and again, it doesn't matter in the US which political party is in power. Both sides are in favor of, as we saw during COVID, supply chain issues. You want more domestic production. You want to be in control of other things. So kind of going after, China and other countries like that with some of these producers or their production or their business being done in China could slow the growth down of this humongous growth opportunity that's persisted. And with that, you could see a lot of volatility in the underlying companies as we've, seen in the last week and a half or two within the markets. So it's just when we've been in this pure momentum market, as we've seen in the last 18 months, it's one of the most difficult investing environments you can be in because there isn't a lot of fundamentals. You're trying to guess how great the opportunity is ahead. And we've mentioned this in the past, kind of the Bill Gates quote along this, a new technology, the first 2 years of adoption become way, way overvalued. The following 10 years become way undervalued. So you can see how that happens is what's unfolded. But again, when you see some of the protectionism and some of the challenges with political risk, and again, it doesn't matter if it's Republicans or Democrats, both sides are kind of favorable to this. And it's just a challenge to navigate, which causes investors to want to take some profit on some of this humongous momentum that's built up. And again, it's something you want to protect your profit. You don't want to just give it away in taxes. But again, it's really being mindful of having that long-term balance in your portfolio as well.
Right. And I think as we start looking at, if you've got, cash today, and you might not have the exposure to some of those larger, names in the space. What are some of those second or third tier type investment opportunities, sort of the different periphery industries around AI that we can invest in? I think when we say, all right, well, let's look at it from, say, our chips for the most part are produced in Taiwan. When you look at the diversification of your supply chain, Jared, as you said, there's a lot of companies that are trying to bring production domestically. And you've been seeing a lot of companies talk about their capex to build up their foundry capacity within the US. I don't know, do you also look at some of the smaller, chip companies, or do you even say, all right, well, maybe if we want to kind of stay away from the chips, do you look at other types of tech companies that are utilizing from a data standpoint to either improve or use AI to say improve marketing, improve advertising, improve overall efficiencies? Are there companies like that are able to sort of use the technology itself as opposed to the hardware that would make a attractive opportunity from an investment standpoint?
Well, and as we talked about last time, Michael, Megan had the data. I mean, the growth in GDP over the next 6 years, forecasted from the humongous opportunity within AI is substantial. And again, when you talk about the direct exposure, indirect, there's just going to be a huge amount of change going on with where companies benefit, where they invest the money to take advantage. And again, whether you talk about some of those or real estate, exposure to certain areas, because the amount of energy needed to power a lot of this computing and need over the next decade and longer is substantial. So, it could be vacant land, it could be farmland that is now going to be converted to solar, right? There's a lot of different ways to think about that second or third tier beneficiaries of this overall play, at this point. And, you're just going to continue to see more and more investment out of, and surrounding the obvious, beneficiaries of this. And there is going to be a lot of opportunity. And when you think about taking that profit, the question is, where do you go with the money? And in general, we think you have that direct exposure, as Megan, you said, continue to take some profit along the way, but there's a lot of opportunity in everything else. Again, assuming the economy looks pretty good at this point, the labor market is holding up and such, and right, some of these second tier areas of opportunity are going to be there for a while.
And I hate to be the one to sort of be the broken record, but I still want to kind of focus on some of the risks as well, aside from the political risk and the and just the market rotation risk that from the, I really want to hit on sort of the energy risk that we're at right now, because I know, Jerry, you said converting farmland to solar farms, and I think one of the things that we have to look at, or that have to have a hard conversation about, is if you do need to have an outsized energy sense of energy production, and do you need to do more or go to sort of more extremes? So like, do you need to start adding more, say, nuclear plants? And how do you get communities to agree to have something like that in their backyard? And I do think that that's going to be could be something that we start hearing more and more about over the next couple of years, because these data centers, they require just a massive amount of energy production. And while there may be space available to produce that energy, we currently don't have the infrastructure set up to do so. And there's going to be probably a lot of red tape that needs to get solved and needs to get cut through in order to bring that energy capacity online.
Well, it's like, as I say, Michael, like we're all in favor of that, nuclear power as long as it's in your backyard,
Yeah,
not mine, right? And that's always the challenge.
that's right.
And along with the risk to be aware of, I think another one in this industry, just to be spatially aware of, is just how intertwined the supply chain really is for a lot of these companies. A lot of them are either mostly dependent on another one in this space, or fully dependent on another company in the space. So really, if there's any risk for one company, it could have a knock-on effect for several others. So just we kind of need to let this space age and mature a little and diversify itself. So there's multiple providers for each step of the way in building chips because it is such a complex process and so expensive of a barrier to entry that it will take a while to build out the robust infrastructure of the supply chain in general. But where it's at today, there is so much intertwined. So just kind of being aware that there is somewhat of a domino risk that you're taking also within the space.
And within the risk to Megan is just the obvious kind of growth trajectory risk, right? As you've entered this stage and the exuberance and peak valuations, as each quarter of earnings reports come in and forecasts ahead, at some point those growth trajectories are going to slow down. And what does that do for your valuations? What does that do for future investment? It's really a big one when you have a momentum market. It's momentum until it's not, then it's back to fundamentals. And it's kind of that, what is the long-term growth trajectory? Right now, the market and investors are expecting probably a lot higher than is sustainable. But it's one thing each quarter's data will help us understand, as we shift from the momentum market more to fundamentals and more to a broadly invested overall market. And I think is one that investors really need to be conscious of ahead.
And I think as we look at some other kind of long-term opportunities as well, I mean, I think this conversation we're having is very timely with sort of the rotation out of a lot of these big tech names, call it the last week or so. But where we could look to find some other types of opportunities, whether it's in the large companies have done extraordinarily well, but they've been pulling back. Again, is this just a short-term kind of correction, or is it do we see this small cap companies that have really outperformed? Is this going to be a new trend? But you also look at things, from say, if we are going to need to invest in the infrastructure, whether it's for energy, whether it's supply chain, this and that, when do you start looking at some of the things like raw materials and how much demand there's going to be for that capacity? And really, I think just generally speaking, talking about if we are in the midst of a rotation, how do we invest for that? How do we, as we've been saying, take some gains and reallocate? I think that's going to be an important thing as we look at taxes, as we look at other types of planning opportunities as well.
Well, and Michael, with that comes the Federal Reserve and interest rate policy to help answer that question eventually, right? We've been in an investing environment the last couple of years of higher for longer and higher interest rates as the Fed has raised. We're in the midst, it appears, to a major shift the other way, where right now the markets are forecasting 100% probability, which can change, that the Fed will cut interest rates the first time in September, right? As that reality hits and gets back to the question, where do you invest your money going forward in a lower interest rate environment as the Fed's likely to be cutting rates over the next 18 to 24 months? Where does capital go? How do you evaluate companies overall and who's the beneficiary in a lower interest rate environment? That's where you could start to see, a continued rotation overall within the market. As always, investing capital is looking for its highest and best use, or its best opportunity, risk reward overall. And again, we're in that changing landscape from higher from longer to a lower interest rate and lower inflation environment, it appears at this point.
That's right. And I think, with that in mind, I'd like to thank, Megan and JR for having this conversation with me. And hopefully you all enjoyed as well. And we'll see you all next month.
Thank you.
Thank you.